How do we plan for cash flow? Well, let's look at what cash flow is first, before we answer this question. Cash flow is the income or payment from the sales you have made coming into the business, less all the outgoings or costs of the business, increases, decreases, otherwise known as inflows or outflows. A cash flow statement is not always included with the statutory accounts your accountant prepares, but it's a really useful tool for helping you measure your net cash position. In essence, helping you to know in advance and plan so you don't have any nasty shocks when you come to pay. For example, your VAT, value added tax, or your tax bill, and you discover there's no money in the business bank account to pay for it. Cash flow statements are an essential part of any management accounting reporting pack, and so you should definitely ask your accountant for them. As your business grows, getting clarity on your numbers on a regular basis, usually monthly or at the very least quarterly, is critical to your decision making. The needs of the business are constantly changing, and your cash flow will highlight any shortfalls in cash which need to be bridged. And it's the number one cause of businesses failing due to running out of cash. Good cash flow management is critical to running a successful business. You must be able to pay your bills whilst you're awaiting your payments from your customers. There will probably be a time lag between providing your goods and services to your customer and getting the payment in for them. This means that you need to have sufficient cash coming into your company bank account to pay all of its bills, whether these relate to invoices from suppliers, employee wages, rent, rate, tax, VAT, or anything else. And cash flow is the number one cause of sleepless nights for business owners. Even if your business is profitable, there may be times when you are short of cash because, for example, you're awaiting payment of a large order. This is particularly difficult if you don't have cash reserves in your company bank account, especially in the early years of your business starting out. So, how do you plan for cash flow? Well, by having a regular statement produced for you so that you always know the position on paper, a budgeted cash flow forecast cash flow, and then measure against it on an actual cash flow basis as part of your management reporting pack. In general terms, you need to speed up your cash inflows, i.e., the payments that your customers make, interest, etc., and you must slow down those cash outflows, within reason, of course. These could be the purchase of stock, equipment, loan repayments and tax charges. As I say, as much as you possibly can, of course. So, what does this mean? Invoicing regularly, chasing those bad debts, maybe considering factoring even, negotiating extended credit terms with suppliers where possible, and managing your stock effectively. In fact, reviewing your whole credit control process. Remember, all businesses naturally have peaks and troughs, and it's important that you put money away during the peaks so you can dip into it during the troughs.